A. Define the purpose of pro forma financial statements and their relationship to budgets. Pro forma financial statements translate budgets into projected financial results. The pro forma income statement estimates expected profitability, the pro forma balance sheet projects financial position at period end, and the pro forma statement of cash flows forecasts liquidity movements. Together, they provide an integrated view of future financial performance. They synthesize information from all operating and financial budgets. Sales, production, expense, capital expenditure, and cash budgets collectively feed into projected revenues, expenses, assets, liabilities, and equity balances. This ensures internal consistency across planning documents. They support strategic evaluation and financial feasibility analysis. Management uses these statements to assess whether operational plans are achievable, sustainable, and aligned with long-term objectives before implementation. B. Prepare pro forma income statements under various assumptions. Revenue projections begin with sales forecasts. Managers apply expected unit volumes and pricing assumptions to estimate total revenue. Alternative scenarios may incorporate changes in pricing strategy, market demand, or product mix. Cost assumptions determine projected profitability. Variable and fixed costs derived from production and operating budgets are incorporated to calculate gross margin and operating income. Adjustments for depreciation, interest, and taxes complete the projection. Scenario analysis enhances decision-making. Preparing multiple pro forma income statements under optimistic, pessimistic, and most likely assumptions helps evaluate risk exposure and sensitivity to key variables. C. Evaluate achievement of strategic objectives using pro forma income statements. Profitability metrics indicate strategic success. Measures such as gross margin, operating margin, and net income are compared to strategic targets. Improved margins may signal effective cost management or pricing strategies. Alignment with long-term goals is assessed. If projected earnings support planned reinvestment, expansion, or debt reduction objectives, the strategy appears financially viable. Weak projected performance may require strategic reassessment. Variance from benchmarks highlights risks. Comparing projections to historical performance or industry standards helps determine whether planned initiatives enhance competitive position and shareholder value. D. Prepare pro forma balance sheets and statements of cash flows from projections. Balance sheet preparation requires projecting ending account balances. Assets such as cash, receivables, inventory, and fixed assets are estimated using supporting budgets. Liabilities and equity accounts reflect financing decisions and retained earnings changes. Cash flow statements reconcile income and liquidity. Starting with projected net income, adjustments are made for non-cash items and working capital changes to determine operating cash flows. Investing and financing activities are incorporated from capital and financing plans. Interrelationship ensures internal consistency. Net income affects retained earnings, and ending cash balances must agree across statements, confirming the accuracy of projections. E. Identify factors required for medium and long-term cash forecasts. Long-term forecasts incorporate strategic investment plans. Capital expenditures, expansion projects, acquisitions, and research initiatives significantly affect future cash requirements and financing needs. Working capital trends influence liquidity. Anticipated changes in receivables, inventory turnover, and payable policies must be projected over multiple periods to estimate sustainable cash flows. External economic and financing conditions are critical. Interest rates, credit availability, tax policies, and market growth assumptions shape long-term cash planning and financial flexibility. F. Determine required outside financing and dividend policy using projections. Projected cash deficits signal financing needs. If pro forma statements indicate insufficient internal cash generation, management must evaluate borrowing, issuing equity, or adjusting investment timing to maintain liquidity. Dividend policy depends on earnings and cash availability. Management must balance shareholder return expectations with reinvestment needs and debt obligations. Excessive dividends may constrain growth. Sustainable growth analysis supports capital structure decisions. Financial projections help determine optimal leverage, funding mix, and dividend payout ratios consistent with long-term strategic and financial objectives.